everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day. On this episode, I'm very excited to welcome in Michael Pento to the show, a veteran of the finance industry with over 30 years of experience and the president and founder of Pento Portfolio Strategies. We're going to break down the recent trade deal reached by the US and China, a reduction in tariffs. But is this really a win for the Trump administration or an admission of defeat? We're going to discuss the gold market and get Michael's view of just where we are in this current bull cycle for the metal. We're going to dive into US dollar dominance. Is it at risk of collapsing? All of this and so much more up ahead with Michael Pento. Michael Pento, great to have you back on Commodity Culture. I want to kick things off with the latest news when it comes to the Trump administration and China and the trade deal that they've seemingly cut now, the reduction of tariffs. This is from Reuters. The U.S. will cut extra tariffs it imposed on Chinese imports in April this year to 30% from 145%, and Chinese duties on U.S. imports will fall to 10% from 125%. The two countries said on Monday the new measures are effective for 90 days. The broad market took this as an indication that it's game on again. Many are speculating we're back to a raging bull market. Everything's good in the world. Back to business as usual. What are your thoughts here?
Well, there are many. I'll try not to pack it all of my thoughts into one question, but that was a great, omnibus question. So, well, first of all, the tariffs are higher now. The rate of change of increase in tariffs in any year has never been greater. So if you look at the 10% baseline across every nation on the planet, and then you have 30% because you have 20% tariffs with the fentanyl, brings it to 30% on China, and that's a pretty heavy duty. Now on the second derivative from 145 to 30, it's wonderful. I go back to because to be in all honesty, I was offsides on this trade because going into it was 145%, and then Trump says, well, I think we can get it down to 80. This was the weekend, but he says according to Scott, he said up to Scott B is what he said. But 80% was where he thought these tariffs would go down to, and then they come down to 30% out of nowhere. So I was kind of like, wow, this is Jesse, anything can happen, because the way I look at it, this wasn't, and I say this meaning we had a bear market to start off the year. Pento Portfolio Strategies was positioned for no gain in the stock market this year. So it started coming into late December and started 25. I took the portfolio's risk way down. I overweighted bonds. So I said, not that I thought that the market was going to crash. I said, well, the upside is just really limited here based on valuations and growth outlooks. I did not anticipate the market falling 20%, but it plunged because of the tariffs. So, but the tariffs weren't some like liquidity shock or a recessionary shock right away. It was a self-inflicted wound. And they're completely and arbitrarily, capriciously up to one person who can make the tariffs anything he wants. I mean, tomorrow Trump can wake up and not like something he heard about, from Emperor Xi, and the tariffs can go up to 100%. I mean, I don't think he's going to do that anymore, because he started a trade war, which I think needed to be fought, but he fought it with tariffs, which I thought was a really dumb way to fight the war. I don't think he's going to ever. I mean, he's desperate now. Remember we said the market was yippy and afraid. He's desperate never to go down that road again, because the market was shutting down. We were going into a full-blown deep recession and a liquidity crisis within a matter of like a week. He declared April 2nd was Liberation Day, and by April 9th, the Liberation Day lasted 12 hours because he had to retreat immediately. So he'll fight these wars in other ways, saying, okay, you need to buy X amount of goods from the United States, mostly, I think, Boeing airplanes and agricultural commodities and energy from the United States, which is where I actually moved my investments more towards, even this morning. But to think that everything's okay, listen, the market's now trading at almost 22 times earnings growth that is 14%. Jesse, when you're trading at 22 times, it's a very rich multiple on earnings growth of 14%. You have priced in a whole heck of a lot of good news in this market. So we're not short the market now, not net short. We are net long the market, but I just think the upside is very, very limited. You still have, and let me tell you why. You're not going to get 14% earnings growth, and you still have the problems. Let me just go through them really quickly. So we have population growth due to the border closure is not growing. So labor force growth is no longer growing in this country the way it was before. On a rate of change basis, it's plunged. And then you have the Doge cuts. You have some cuts that have been made in fiscal. I mean, they're trying to pass this grand fiscal package. I don't think it gets passed at all. No taxes on tips, no taxes on Social Security. They might raise the SALT cap deduction a little bit. But where's the tariff revenue to offset this? I mean, we do have some freedom-loving Republicans who said, enough is enough. We cannot. All we're going to do is probably end up extending the TCJA, the Tax Cut and Job Act, which is no change in the tax status at all. So you're not going to get any real big juice fiscally. But who knows? I mean, who knows what these people in Washington, D.C. will do? It really should not happen. If it does happen, I think you can get a spike in long-term bond yields. Long end of the bond market might go into complete revolt. But don't forget, you still have a real estate debacle. You're on the threshold of a real estate debacle in this country. And you also have a liquidity crisis. The reverse repo facility is almost completely dry for all intents and purposes. It is now dry. The Treasury General account is in the process of being drawn down. It had a slight blip up from the April receipts, but that's come down. The level of the real Fed funds rate has been positive for now almost 2 years. That's always been a precursor to a recession. So here's my view. I'll boil it all down. Market is very expensive. There is some upside, but it's very limited. A steep recession has been temporarily taken off the table because of the tariffs. How long that lasts, I'm not sure, but I run my model every day, and my clients will be on top of it.
And now a quick break to hear from our sponsor, ARC Silver Gold Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Could you break down in a little more detail what you're seeing when it comes to the liquidity crisis and the reverse repo market? What's the dangers that you're seeing there?
Well, I mean, the liquidity for the bond market has come from the reverse repo facility, which was at one point $2.4 trillion in 2022, and now it's the last time I looked was $100 billion, like $140 billion. The Treasury General account, which is what the receipts and the extra money that the Treasury keeps at the Fed, that's only about $400 billion. And that's coming down very quickly too. So I think they're going to have to extend the debt. You still have a lot of conflagration in Washington, D.C. They have to extend the debt ceiling, right? Otherwise, we're going to drain that down to zero. And then you, most importantly, you have the real Fed funds rate. There's real borrowing costs out there now. The Fed is not proactively going to cut rates any longer. The way they used to in, like, say, leading up to the 2000 recession and the NASDAQ debacle, or leading up to 2008 global financial crisis. The Fed was, at the first whiff of a crisis in 2007, the summer of 2007, the Fed was cutting rates. They dropped it by 50 basis points. They dropped rates 100%, 100 basis points from 5.25 to 4.25, but they have not moved now for many months, and I don't think they can. I would be surprised if they move more than once or twice this year. So I'm not going to proactively get ahead of it. You still have a positive level of real interest rates. It means it costs money it costs in real sense, it costs you money to borrow money from the bank. It's not like it was like back in 2020, early 2020, 2021, where real interest rates were -8%. You could go and borrow money and just buy anything, a house, a stock, commodity, and inflation was running at 9%, and it cost you almost nothing to borrow the funds. It was under 1%, so it was an 8. You were guaranteed to make money. This is no longer the case. So that's the liquidity that's still out there. So yeah, for me to say, wow, we've started a new bull market. For me to say that, you would have to have some massive fiscal stimulus. You're not going to get any monetary stimulus. You're running out of liquidity. You would need some massive fiscal stimulus passed, which includes all those extra tax cuts that Trump wanted to do. And it would have to happen in the context of a quiescent long duration bond market. I just see the odds of that very low at this point.
And what about when it comes to the issues in the real estate market that you're seeing? What should investors be paying attention to when it comes to a potential real estate crisis up ahead in America?
Well, listen, the home price to income ratio has never been higher. That is the best metric available to mankind to judge how out of whack the real estate market is. I don't just look at prices of homes. That tells you nothing. It's the home price to income ratio, which is an all-time record high. And when you add in taxes and insurance and maintenance costs, home prices are the most unaffordable they've ever been in history. And you also had a phenomenon where, since interest rates were so low for so very long, negative in a real sense for 10 out of 14 years, from 2008 to 2022, people just borrowed money. Institutions borrowed money mostly and just bought houses. There were years where 25% of all homes, single family homes were purchased by investors. And that's why everybody you know with any money has 5 homes, and institutions in Wall Street, just like Blackstone, just piled on houses. And those houses were a great investment when the carrying costs were very low. In other words, taxes were low, insurance costs were low, maintenance costs were low. You had a renter that paid you a steady income stream, and the price was going up. And now you see inventories spiking in nominal terms. You look at days on market spiking. The mortgage rates have spiked from 3% to close to 7%. So yeah, we have a housing debacle. And who owns these mortgages? These mortgage-backed securities are held by banks, both shadow and in the primary dealers. So yeah, we have a big problem coming up in the banking system, in my opinion, with mortgage-related assets.
Seems like a lot of crises on multiple fronts. I do want to pull on the thread of, you mentioned that you've rotated some capital into energy and agriculture. Is that correct?
That is correct. I did that this morning.
In the past, you have a model that you use, and in the past you've said, past interviews we've done, you said now is not the time to go into the commodities sector.
Right.
So what has changed that caused you to make this shift?
Well, we were headed, I correctly predicted the fact that the economy was going to be very slow. And then when the tariffs came on, it was a guarantee, in my opinion, and the opinion of the Atlanta Fed, it was a guaranteed recession. I mean, the first quarter, according to the Atlanta Fed, was shrinking by 2.3%. Even if you take gold imports out of the picture, it was still a negative quarter. And so that's January, February, March. April was Liberation Day. That's Q2. And international trade shut down with China. Shut down. There were no vessels headed to China. It was empty shelves, and whatever was there would cost you a fortune, guaranteeing you a recession. So that requires you not to own riskier assets like Bitcoin or energy or commodities. You own, in that case, gold. You overweight gold in your portfolio. But now that Tariff, I don't say Trump surrendered, but I mean he unilaterally caved in. And I want to just say that I voted for Trump. I'm a fan of Donald Trump. I think he learned his lesson that tariffs to that level, to that extent, cannot be used without detrimental effects, not only in China, but here too. So, like I said, we were having a commercial paper crisis, a repo crisis, credit crisis was erupting here. So what he's done is he said, and I want to preface this by saying he's had a very noble effort. He wanted to repair the middle class of this country. He still does, but he wanted a balanced trade. He wanted to rebuild the manufacturing base in this country. It's a matter of national security. I'm 100% behind him. He just learned the hard way that you can't do it solely on tariffs. A better way to do it is say, hey, let's just say China. We have a massive trade deficit with you. If we have a trade deficit with you, you promise as a country, as a government, to buy X amount of dollars or X percent of that deficit. That would have been a better way. And if you don't do that, then we will slap a tariff on you. But he went about it the other way, just slapped tariffs right away. So I think he's learned his lesson. So I don't say he caved or retreated, but listen, everybody makes mistakes. You learn from your mistakes, and that's what he's done. I am not ever going to believe this was part of some kind of 4D chess game that he's playing. So the bottom line is you want to overweight gold in a recession and underweight commodities. And now you still want to have some gold, but I think you want to overweight commodities now. And that includes agricultural and energy commodities, because a lot of these trade deals that I think are coming are going to involve the purchase, like I said, of what the U.S. does best, which is energy, agriculture, and aerospace and defense. That's where you want to be. That's where you want to have most of your portfolio right now, because the rest of the market, chasing the Mag 7 to the moon is going to, I think it's a fool's errand.
Do you think there could be some reverberating effects from this tariff war when it comes to just the uncertainty that it's created? For example, if you're a business in the United States that purchases a lot of goods from China, and you saw this huge tariff go on them, and you thought, okay, well, I need to now figure out either, get these goods in America or figure out some other way because the cost is just way too high. I can't pass that on to my customers. And now suddenly Trump has said, we're reducing it to 30. I don't think those people are necessarily breathing a big sigh of relief, because they're going, okay, well, now it's in effect for 90 days. What's going to happen after that? And like you said, what if Trump wakes up one morning and something China did or said makes him go, you know what, we're putting the tariffs back up. So I think there's got to still be that aura of uncertainty surrounding future trade with China. Do you think that could have a big impact moving forward?
100% correct, Jesse. There's an inexorable trend in international trade and in international currency reserves. Countries are moving away from treasuries and the U.S. dollar. Think of it from China's perspective. China had 10%, then it was 54%, then it was 145%, and now it's back to 30. At 30% is still pretty hefty duty on China. But here's the point: if I'm China and I see what happened with Russia, and I see what happened to my own country with the trade war, how much of my currency reserves, my trade surplus, do I want to recycle in dollars and treasuries? And the answer is a lot less. So going forward, you're going to continue to see gold supplant the US dollar as the world's reserve currency, which is why I still think holding some gold, even though I don't think a recession is imminent any longer. Again, I reiterate, I don't think we're going to have a booming economy and a booming stock market, but I think the deep, recession / depression is off the table for at least now. Who knows what happens in 90 days? Jesse, I have a very robust model that I use to predict these machinations, but there is no model for any one person's brain. And Donald Trump has a lot of power. Those executive orders can come fast and furious, and you just don't know what's going to hit you. So tariffs can go up, tariffs can go down no longer, though. I don't think there's any chance that the tariffs will go below 10% on the world, and probably not below 10% on China. Even if let's just say the fentanyl stops and the tariffs can maybe go to 10%, but who knows? I'll reiterate again. It's up to one man. He has the power over the executive orders. He can make them whatever he wants. You could tie it up in court, but in the meantime, the damage is done, and the inexorable trend of moving away from the dollar as the repository of a trade surplus, that is not that is going to be that is only increasing, not going away.
So you said that it's shifting towards gold, and that at the moment, though, you're not as overweight gold as you were before in anticipation of a recession. So how do you view gold's role in a portfolio at present? You have the people who are obviously wild gold bulls who say this is going to 5,000, 6,000, 10,000. Talk to James Rickards. He says 23, 26,000 at some point. What are your thoughts on where we are? Is this gold bull cycle still in its early stages? And how do you view gold's role potentially in the monetary system up ahead?
So as I said, I think gold is replacing the dollars, the world's reserve currency. So it's an absolutely essential hold. I think gold does best, and I've been doing this for 34 years as a professional investor. So gold does best in recessions. I just don't see that happening anymore. I love to see nominal and real interest rates plunge. That's when gold really shines the most. And I just don't see nominal rates falling right now. Nominal rates are going to rise. And I think that on the long end, they could really spike, especially if we start massive fiscal deficits again, even more than we already have, Jesse. I mean, think about this tenuous fiscal situation. You know, the Congress can score the extension of TCJA any way they want. They can use accounting gimmicks, but that will add about $4 trillion to the deficit over 10 years. Now you're going to get a little bit better. You're going to get some growth. I'm a big proponent of tax cuts, and I'm a bigger proponent of cutting spending. But when you cut taxes and you increase spending, I mean, you can really put a dent in the deficit, and we don't have any room for that. We're running $2 trillion deficits in peacetime and in supposedly prosperity. What happens in a recession? Those things tend to triple. So you can get a $6 trillion deficit. So if you're looking for, like I said, I am now net long the stock market. I have some protection with gold. I have some inflation hedges in the portfolio. I have a lot of short duration bonds because you're still getting paid 4.25% guaranteed. I don't think the Fed's going to be cutting the Fed funds rate anytime in the immediate future. But having said that, the room on the upside is very limited, in my opinion, especially for the Mag 7 and the stuff that everybody wants to own, regardless of what valuation. They don't care. They just want to own those 7 stocks. So that's a big problem.
Is silver on your radar at all right now? You know, a lot of people are pointing to the gold silver ratio being very stretched historically, as well as silver being in a structural deficit for a number of years. So industrial demand could put a squeeze on that supply. Increasing demands. A lot of people, the extreme gold bulls will say, well, gold's going to go so high that your man on the street's going to take notice, which has started to happen a little bit in the West here and there. We're seeing a few mainstream articles, not a whole lot, but let's say gold starts 3,500, 4,000, and people, your retail crowd goes, okay, I want to get into that, but an ounce of gold is too expensive. So, of course, the poor man's gold people are going to look at silver as an alternative. How do you view the picture for silver? Separate the narrative from the reality for us.
Yeah, I do not look at the gold silver ratio ever, because that if you use that as a timing tool, it's just all it does tell you is that gold is more expensive than silver than historically the case. But that's not a reason for me to buy silver and sell gold. Silver, and it is on my radar to answer your question for the first time in a very long time. I like silver in times of when global growth is going to accelerate in times of monetary chaos. That's when silver tends to do better than gold. Because I said, silver is a monetary metal, but it's also an industrial metal. So if I can get a situation where global growth is going to be okay, and I think that's the case, but we're going to have a problem with inflation, that's when silver shines the most. So yes, silver is on my radar for the first time in a very long time. It could even outperform gold for a while. Normally, and that's and historically, Jesse, it's a very rare situation. Normally, gold is much better. But gold is real money. So during times of monetary chaos, you want to overweight gold. During times of recessions, you want to overweight gold. But when you see inflation and growth accelerating on a second derivative basis, silver will tend to outperform gold.
Are you looking at gold and silver mining equities at all, or you just stick to the metals?
Right now, I'm only in royalty companies. So, but yeah, you know, the volatility on silver is through the roof. The volatility on silver equities is a derivative of that volatility. It's a much higher rate of change volatility. So yeah, I'm not looking at the silver equities right now, but just the metal.
Royalty and streaming companies when it comes to the precious
Yeah,
metals miners, yeah.
correct. Yes.
So Trump has proposed increasing military spending to over $1 trillion for 2026. And meanwhile, it appears that the Doge Committee has been fairly ineffective at cutting any sort of meaningful amount of spending. Would you concur with that? And what does this all mean for the debt and deficit situation moving forward in the U.S.?
Yeah, we touched on that. We touched on that already. I mean, I'll just reiterate the fact that it's a disastrous fiscal situation we have in the United States. What party really wants to cut spending? When the Democrats are in power, the Republicans are, hard money, balanced budget governors, and then when they're in power, it's like, maybe the Democrats say, "What about all this debt?" But what party out there is advocating for a reduction in the deficit to GDP ratio or the debt to GDP ratio? But I don't see it. That's why I increased the two reasons why I increased the position with aerospace and defense is because that's what I think is going to be very beneficial from the trade conflagration. And that's one of the things I think they want to increase military spending by 13%. You got to go where the money is, unfortunately. But what that means for the long end of the bond market, I think, is where you might get so you're not going to get a break. It's completely unfettered chaos in DC is when it comes to spending. But the break in DC may come from the bond market. Just like the break on the tariffs was the bond market, the break on this, runaway profligate spending could also be the bond market. So all eyes are on that.
Any thoughts on the spike in the 30-year Japanese government bond? A lot of people are pointing that out as some sort of alarming economic indicator. Have you been paying attention to that? And
I sure have.
What are your thoughts?
Yeah, well, that was one of the for decades, the Japanese have had no alternative but to buy other higher yielding currencies and bonds from other nations. Now they actually have an interest rate in Japan that pays them something. So when you factor in the currency hedging that's necessary, I think Japan is the largest holder of U.S. debt, about $1 trillion worth, or maybe even 1.2. I'm not saying they're going to sell all their debt, but the buyer. So if the Fed is not going to be buying the debt, and foreigners aren't going to buy the debt because we just talked about the international chaos with tariffs and confiscations and whatnot. And Japanese have an alternative now, right? Well, who's the buyer? Who's going to buy the trillions of dollars in deficits and rollovers? This $2 trillion deficit, $8 trillion in rollover. Who's going to buy it all? So I think it's going to be banks and individuals, mostly in the United States, and they're going to require a yield that's much higher if Congress continues this path.
And are you looking into international markets at all? Do you stick mostly to U.S.? either emerging markets or just anything non-US, the European market. We saw the DAX hit all-time highs recently. Wonder what your thoughts are there. Perhaps the Japanese stock market and anywhere around the world that you're seeing value at present.
I'm invested in India. And I think that would be one of the main beneficiaries of U.S. divesting out of China. So Apple's going to be making most of their phones in India. A lot of the manufacturing, I think, will go into a much more friendly nation, India. The vice president's wife is from India. Modi seems to like Trump. Trump seems to like Modi. So, and they're having a meeting in like a week or so, India and the United States, to try to get this trade deal done, which I'm sure they'll come up with something and declare it the biggest deal ever. So yeah, I do like to diversify outside the United States. I use India currently, but I might you're talking to me today. I'm an active manager. I don't think you should just buy and hold. I don't like, when the market crashed in February, we didn't suffer any downside. And I try to smooth out the bumps. I mean, there might be times when I underperform the market, but there are times when I outperform the market. The standard deviation here is lower than most because I just use an active management to make sure I don't suffer those big downfalls, but yet participate in the bull markets. That's the goal here, and will always be that case.
Do you take global conflict and those sorts of geopolitical events into account much when it comes to your investment decisions? Obviously, we've seen India and Pakistan having issues, attacking each other. Russia, Ukraine, at this point in time, doesn't seem like it's going to slow down. We'll see. Apparently, now Zelensky wants to meet Putin in Istanbul. We'll see how that comes to fruition if they're able to come to an agreement. Israel and Hamas, of course. I mean, the list kind of goes on at this point. Do you mostly block all of that out when it comes to actually the nitty gritty of making investment decisions, or do you think that there's something there worth paying attention to?
I don't say, oh, there's a headline that India and Pakistan are in another. These spats are going on for a very long time. It's nothing new. So, and they usually flare up, and then they put some cream on it and it dies down. So, I don't look at that. I have a model that lets me know when I should worry about, a potential incursion, possible World War III, some kind of conflict that's going to hurt the economies of the world. But yeah, I have a model for that. But what I don't ignore is saying, wait a second. What's happening now is there's peace and trust is not breaking out all over the world. I think that's a an objective observation. So again, that underwrites my theory that you need to own aerospace and defense here, because I think a lot of these countries are going to be forced in these trade deals to buy more things from the United States, more defense equipment from the United States, because a lot of these countries can't produce it themselves, and they understand they have to defend themselves now too. So even Japan. After World War II, they weren't allowed to have any weapons. Germany, after World War II, wasn't allowed to have an efficient army, but now that's all changing. So I think a big beneficiary will be America's aerospace and defense industry. But as far as like, there's a headline about India, Pakistan, or some breakdown in peace talks within the Middle East. That's not, unless it affects credit spreads and financial conditions, I'm not interested in it. I mean, I pray for peace, always. I'm very interested in that. But as far as portfolio is concerned, it doesn't interest me.
Tell us about Pento portfolio strategies, where people can find that, what it is you do there, and your midweek reality check podcast.
So I run an RAA like a hedge fund. So I'm a long short strategy. But I don't buy and hold anything. I use the second derivative of inflation in the context of growth to guide me across the spectrum between deflation and stagflation or intractable inflation. There's 5 sectors there, and that way you can avoid owning the wrong the wrong stocks, wrong bonds, wrong currencies, the wrong commodities in, say, sector one, which is recession and deflation. You don't want to own energy or high beta stocks in that example. Whereas if you have a period of stagflation or even hyperinflation, you want to overweight your base metals. You want to overweight your energy. You want to overweight gold. But you don't want to have a large amount of duration in your portfolio. You don't want to have any. You want to short bonds and that. So that's that kind of thinking that I follow in my model. It's called the inflation, deflation, and economic cycle model. And if you're interested in learning more about that, the website is pentoport.com. I also have a midweek reality check podcast I record every Wednesday. And that'll give you some thoughts 36,000 feet in the air for about, what's the main things I'm looking at, the main salient economic data and the objective interpretation thereof as it applies to that second derivative of inflation in the context of growth.
Great. Well, I'll put a link in the description below to pentoport.com for people who want to check it out. Thank you so much, Michael, for coming on the show again. It's been a blast.
It's always a pleasure, Jesse.
Thank you for joining us today. This episode is brought to you by ARC, Silver, Gold, Osmium. Take advantage of their specials right now. Silver Kangaroos 2023 1-ounce coins mint fresh at $2.47 over spot. And Silver Maple Leafs 2025 1-ounce coins mint fresh $2.87 over spot. While supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.